first thing I thought before I get into my presentation is, Minister, you taught me something today. As an economist, or rather, as economists, we're slightly different from politicians in that we don't write our speeches down so that you can't actually quote us, because typically these things will change. So generally, what we would have heard over the last 2 years, and earlier this year at Davos, they spoke about the word polycrisis. And the polycrisis was voted as the word of the year last year. And, when you're invited out, given the state of affairs in the world right now, I thought Gavin and his team were incredibly brave to have an economist speak to you on a Saturday morning, given the state of the world, because typically the messages we're delivering right now aren't good news. But when I thought about my talk and what I was going to be talking about, to talk about the polycrisis, which is typically defined as an occurrence of very different, severe, catastrophic events that happen at the same time that you have to deal with. And I thought to myself, well, to come here and drone on about all the negativities of the world would be incredibly difficult. We are all engaged citizens of this country, and we know the challenges we face, and it will be difficult for me not to touch on them and to talk about them. However, as we've learned in the banking sector, you never ever waste a good crisis. And so if we're facing a poly crisis, it implies by definition that there's poly opportunity. And so what I will try and do today is kind of talk factually, matter-of-factly, about what is happening in the world, but try and see if there are things that can be done. Because Bongani, you said it earlier, one of my mentors said to me a while ago that South Africa's been on the brink of catastrophe every year since 1948. Every single year. And another thing that is particularly interesting about us South Africans is the way we think about our economy and our country is the same way as we think about the Proteas at a World Cup. So what often happens is we start off by being deeply despondent. And we kind of go, I'm not going to support this year. I know they're going to choke, I'm not watching. And you stop watching. And then they play the group stages and you kind of go, okay, wait, this is different. This year it's different. They go, this is the one. And by the time we get to the quarterfinals, you've got your 6-year-old in full Protea regalia, you've painted your face, you've got a black label on a Saturday morning because they're playing in Australia, you've already started the breakfast braai, and you're fully invested. And then the final happens, and then you get heartbroken, and the cycle starts again. All right? So typically, that's how the economy in South Africa works, and that's how we've run it for the longest time. So what I will do is, there's a clock that I'm going to try to keep to it. I will speak for sort of half my allocated time. Please feel free to send through questions, and I'm very happy to have a dialogue. Okay, if I can figure it. Perfect. So along the theme of the poly crisis, it was Vladimir Lenin who was ascribed to the following quote that said, there are decades when nothing happens. And then there are weeks where decades happen. And what we've lived through in recent times has been exactly that. Just multitudes of global events that have been just unsparing. And when you're a small open economy like South Africa, often you are at, you are at the whims of these things that happen. So if I think about it now, we had the global financial crisis that happened in 2008, and there was absolute anarchy. And being in a bank at that time was insane. In 2013, there was a massive event known as the taper tantrum. In economics, we call it the taper tantrum. And that was the US and Europe saying they're going to put less money into their economies. So what happened after 2008 is those economies said to support our economies, what we're going to do is flood the market with liquidity. To give you a sense of the size of this liquidity, in Europe at the peak of their quantitative easing, they were putting 85 billion euros a month into the economy through the banks. And what this led to is a massive wall of liquidity that came in, and that drove interest rates down. So what we saw for a very long time was very low interest rates in developed economies, and as a matter of fact, some of those interest rates went negative. Now, as soon as that happened, and I remember in 2014, I was a trader at the time, when I looked at negative interest rates, one of the things I wanted to do was to call my alma mater, which is University of Witwatersrand, and ask for a little bit of my tuition back, because they never taught us that. You see, when you study economics, you tend to think that interest rates bottom out at zero. But as soon as you have negative rates, the world it's a different story now, because now the floor is infinity in the negative, and what does that actually mean? And I remember being in the UK and seeing scenarios and transactions. For instance, Apple raising money in the European economy with 3-year interest rates was minus 1%. So Apple was raising debt at a negative interest rate. And people were going, wait, so what does that mean? Does that mean you lend them money and you pay them to lend them? Practically, what does that look like? So banking systems, they got discombobulated and things just didn't make sense anymore. And that's the world that we've been operating in. Okay, and so what you will hear a lot of this year is rampant global inflation. The truth is it is very hard for inflation to not be where it is when you've had years and years of very cheap money going into these global economies. But what it also did for countries like ourselves is it masked a lot. You see, when you have 85 billion euros going into the European economy every month, and there's very low growth in Europe, what European bankers then did is just buy bonds for emerging economies. So at the time, South African bonds are paying you 7%. You're getting money at naught in Europe. So you're taking that naught and investing it at rand at 7%. It's, pretty easy to get a return. Now, I'm a proud banker. I've been a banker for a very long time, but I do understand why sometimes the world doesn't like us. Because in that scenario, that money was meant to help the European economy grow, but that money was redirected to emerging economies. So what banks ended up having was super profits in a world where environments and their local economies were struggling. The bank I work for at Investec, we pride ourselves on living in and not off society because we believe in creating enduring worth. And so as you think about banking products, we have to think about it in the context of the environment within which we operate, not in isolation. Post all of that, you then had Brexit. Brexit for me was the most incredible thing I ever experienced being in London at the time because the day after the vote out of the EU, the most Googled search, the most Googled phrase in the UK was, what is the EU? The day after the vote, let's just be clear. Now, Google is a phenomenal thing for these very quirky things. But what we realized there again, there was this massive concern around nationalism and people looking more inward than outward. And if you remember 2016, this was a time where the potential president of France and the potential president of the Netherlands were incredibly right-wing. And so there was a lot of nervousness around the world. And you see, sometimes the benefit of being on the southern tip of Africa, on the other side of the world, you're a little bit shielded from actually what was happening out there. And so one of the things we did most poorly as a country at the time was, whoa. Okay. Can you guys still hear me? Can I carry on? Like, cool, all right. One of the things we did at the time was a lot of countries were dealing with their own geopolitics and their own concerns. And we attracted them to ourselves negatively. So if you think about some of the stuff that happened with Minister Nene and the likes, that was us shining attention on ourselves at the worst possible time. To use the analogy, when you're in university and the professor asks a question and you don't know the answer, typically what you do is avoid eye contact, pretend to be looking for something, whatever. What we did was said, me, pick me. And they said, yes, South Africa. And we said, oh, wait, I don't know. I don't know the answer. And so we drew negative attention to ourselves for absolutely no reason, right? And so we've come out of this time of massive global uncertainty, but we've drawn negative attention to ourselves at the same time. And so that's the backdrop and the context within which we've been operating. Okay, perfect. My screen is off there, so pardon me, I'm gonna have to keep looking back here. Then we had COVID-19, and the less said about that, the better, because it was a horrendous period of time for many of us. And the supply chain disruptions that followed there was because China really had that zero tolerance thing, where to the extent that any of their ports, should they have one COVID-19 positive case, it shut down the ports. And that created a massive issue. Part of also what we saw with container prices was when the COVID-19 pandemic hit, we saw a bunch of people buying PPE globally. And that went from China to other parts of the world, but exports were shut down due to lockdown. And so what you had was empty containers sitting outside of China. So as soon as global trade came back, if you were a country that was importing from China, you would have to pay for an empty containers to go back to China, get filled, and come back this way. So you're paying double the price for one shipment, which is why we saw container prices more than double. And so that at the time that economies were incredibly fragile and trying to come out of this difficult period of lockdown, you had massive costs come through, and that's also been part of the inflation. So that's the backdrop from which you come from, and then what happens is you have things like the Russia-Ukraine war. I'm not going to comment on South Africa's position on that because we've got an esteemed Ongam who's going to give us his political outlook, so rather him than me. But we've got that's at play. And then you've got rampant global inflation, we've got a power crisis. All of these things are sort of what we're facing. And I was speaking to a group of entrepreneurs recently in Cape Town, and I was saying to them, when you look at the rest of the world, especially last year, you had power insecurity due to the Russia war, you had high inflation, you had rampant interest rates, a low growth environment. And we saw business people and entrepreneurs in the rest of the world look like deers in the headlights. They didn't know what to do. Whereas for us, it was another week in South Africa, all right? And what it showed me and what it showed me was just how resilient, how absolutely resilient people in this country are. It is absolutely incredible. So if I talk about where capital flows, because again, we're a small open economy, so there's certain things that are in our control and others that are not. What this picture intends to show is the bigger bubble with sort of the inflation rate in the middle is the current inflation rate. The one at the top is the previous inflation print, and the small one at the bottom is what inflation is expected to be. The top rate there is a policy rate. So in the context of South Africa, it would be our repo rate, which was increased by 50 basis points this week. And the point of this is what international investors do is they look at your real interest rate. When they look at a country where to invest, they kind of go, what is the level of your risk? And what is your real interest rate, i.e. what is the return I'm going to get adjusted for inflation if I buy government bonds or the likes in that country? Now, if you look at your developed economies, real interest rates are negative. And those real interest rates are negative because inflation is so high. In the ordinary course, you'd expect the interest rates to be much higher. But because they've got such low growth, they're trying to walk that tight line. But if you look at the countries sort of more towards your right, emerging economies, the people that we are often compared to by international investors, you'll see that their real rates are much higher. And so if you look at Governor Kganyago and you listen to him speak, and he talks about South Africa having relatively low interest rates. The reason why interest rate markets expects further aggressive interest rate hikes is because of the sort of a picture. Because when we compare to our peers, we have 4, 5, 9% real interest rates, and we're at 1.4. Before Thursday's hike, we were at less than 1% in real interest rates. From an emerging economy perspective, it's relatively low. Now, I understand that's a very difficult thing to hear because cost of living is incredibly high. Debt and borrowings are high. It makes it very difficult. Cost of diesel, all of that is a little bit higher. But this is just to paint the picture around the context of the global economy that we're playing in because they don't look at us in isolation. The one thing that has consistently been incredibly important for us to understand, though, as South Africans, is that we are deeply inwardly focused. And everything that we do and are is in relation to other emerging economies. And so often you will see, it's not the case now, but often you will see the rand strengthen, or you will see foreign flows into our bonds. Foreign bondholders are still the majority of our bondholders, rand-denominated bonds. You still see inflows into the country. And often South Africans go, but why? Why would you see foreign money still buying South African bonds when we see ourselves where we are? And there's a few things that I think are incredibly important in that. The first one is if you look at South Africa relative to other emerging economies, there are some things where we stand head and shoulders above. For instance, foreign investors don't have issues with exchange control. You can buy and sell South African bonds as you wish. In Brazil, as an example, if you buy bonds, when you sell, there's some exchange control, so you can't get out as quickly as you'd like. Secondly, and one of the things, they call it the first sin in economics, just under 10% of our debt, government debt, is dollar denominated. That is an incredibly important stat to watch. Because countries like Argentina, who seem to have every 8 to 12 years they fail. It's like you can measure it, you can almost predict it, right? And it's generally a currency crisis. You'll see it in Mexico as well. And that's because a lot of their debt is dollar denominated. So if a lot of your debt is in dollar and your country has low growth, and your currency weakens against your dollar, what's really happening is your debt is growing, even if you don't borrow another cent. Because if you have $10 million today and tomorrow your currency is depreciated by 20%, your debt's actually increased by 20%. The advantage we have as South Africa, even with the downgrades and even with the grey listing, is a large chunk of our debt is in rands. So even as the rand weakens, our debt isn't exponentially increasing because we have our debt in local currency. That's the one thing that the SARB has done incredibly well to manage, because many emerging economies take that path of least resistance and raise dollar-denominated debt. We have not done that, and it has avoided a massive amount of pain in this country. Now, having said all of that, what we can't ignore are the facts. I'm not going to stand here and pretend to sugarcoat things. We all know the state of things. This is the context within which we're operating. This we cannot ignore. You see, that 64% is an incredibly important number, because if as a young person, it is difficult for you, at least 1 in 2 chances of finding a job, you're sitting on an incredibly frightening thing. Incredibly frightening thing. There's a stat I saw recently that said, in that 64%, you have a large chunk of those who might be unemployable. Not just unemployed, but unemployable. Given, you'll read stats, I run a mentorship program, and you'll read stats that a lot of children in South Africa who matriculate, get a matric, have the comprehension and reading of a child in grade 5. Right? Have the mathematics ability of a child in grade 4. Those young people become unemployable, not just unemployed. The other stat to be careful of is that our official unemployment rate is 34%. The 46% is the expanded definition. You see, in economics, how they define unemployment is people who are out of work, who are actively looking for work. If you give up on actively looking for work, you fall out of the official unemployed stats. So in a South Africa thing, it's a global standard. So often you can see unemployment rates come off not because people are finding work, but because they're giving up on the process of looking for work. We saw that happen quite a bit in the US. All right? And so you have to be incredibly careful. This is the powder cake. For me, this is one of the biggest risks. Right? We all know the saying about idle hands. Let's speak a little bit about Eskom. So 18.66 being the tariff increase that came through NERSA, that obviously is going to have an impact on inflation. We all know the stats. When we're on stage 6 of load shedding, it cost the country 900 million rand a day. Eskom last financial year to January spent 18 billion rand on diesel. The previous year that spent 6. Right? We all know these stats. And I can throw them out, I can rattle them out. It's not very useful. The point is what we do about it and where are we now. We've done quite a bit of research as a bank, and the facts of it are the following. By 2020, as South Africa, we will have to spend 1.2 trillion rand to sort out this power issue. 1.2 trillion rand. Okay? About 90% of that will probably have to go into generation. Now, my view is a lot of the issues we face in South Africa, and Minister, you touched on this, a lot of the issues we face in South Africa are not insurmountable. They feel that way because of these massive stats, 900 million a day, 1.2 trillion. They feel massive. But if you look at the problems for what they are, and you look at the problems for where they can be solved, I actually think it's more doable than we realize. If we talk about generation with Eskom, my view is that generation can be sorted out largely through private sector intervention. People can sort out generation. That 900 billion that you need done for generation can be done. The thing that then you need Eskom to absolutely focus on is transmission and distribution. So we're going to need circa 8,000 kilometers of lines for transmission by 2030. Because the main issue in South Africa is where you generate power and when you use power are 2 different places. You need a way that the grid connects that and is stable enough to connect that. I'll give you an example, and we're not a massive power user, but in Investec Bank, we sit in Sandton. There's not a lot of space for us to put solar power plants, wind, da-da-da-da. We're happy to invest to do that somewhere else. But the wheeling agreements have to work, that if we're generating our power in the middle of the Northern Cape, we can plug into the grid and use it in Sandton. That's the main issue here, is that we need Eskom, the investment. The public investment has to go into the grid stability and the capacitating of the grid. Generation can get sorted out. And if we work in partnership, right? Minister, you spoke about the private sector adopting roads. We've been working on a model around the private sector adopting power stations and actually running them. Interestingly, there's a power station. If you ever use the Gautrain in Joburg, you go past it. If you go into the airport, it's called Kelvin Power Station. Ourselves and one of the other banks ran it for 6 years. And it operated at an energy availability factor of 70% for that entire 6 years. It's currently 23%. Okay, I think that as South Africans, we all now have to get involved. The day we know we're here now, and we can. There's many things that must happen to talk about how we got here to avoid it going forward. But there's certain things we need to do and to act on immediately to get this done. When we talk about the coal and we talk about the renewable energy, the facts again are this: between 2013 and 2021, the amount of power generation created through the renewable energies, that amount cumulative for that period of time, is the amount we need to do a year for the next 10 years to get to our goals on coal. Right, so what we did over 8 years in renewables, we would have to do that per annum to get to where we're talking about when we talk about coal decommissioning coal. So these are just the facts of it, and we need to put the facts up plainly and then say what is possible given that these are the facts. The point isn't to depress people. The point isn't to use big numbers to scare, but is to say once we know what the game is and what the end goal is, let's work backwards and go, what are the practical steps that need to be taken today in order for us to get there? Historically, South Africa used to get an incredible benefit from commodity prices. The yellow line is sort of the commodity price index, and the black line is the rand. And you'll see the inverse relationship between the two. And the reason that would happen typically is because when commodity prices increased, our mining sector would do incredibly well because they were just selling those commodities at a higher dollar rate, converted to rand, and would strengthen the rand. And what that meant when the mining businesses did well is that taxes on the mining businesses were incredibly high. So from a revenue perspective, we did well. Okay? And so that shielded South Africa for a long time as well. In the context of rampant global inflation, what you're going to see a lot less of is very high commodity prices. So now for that rand to come back, it's going to be us internally and structurally sorting a lot more things out ourselves and not relying on just foreign flows. The world now is paying a lot more attention. So if you think about global inflation like the price of goods, if things are really cheap, you don't pay attention. It's a lot easier to spend a little bit fruitlessly. When things get very expensive, you pay attention. And that's what the world is doing. The world is being very attentive per country to see what your comparative advantage is. And so we will lose the benefit of being able to ride the commodity wave. And so we have to be a little bit better. Those blocks that you see there, some of them are global external factors and some of them are own goals that we scored. And what you will see is when you score an own goal, Nenegate being an example, as soon as the rand hits a new high, now the market goes, oh, okay, so the rand can go to 15. Okay, so the base changes. See, there was a time when if the rand got to 12, we're like, geez, 12, I can't believe it. When is it going to go back to 10? The fact that the rand's touched 20 to the dollar, it's like now it can happen. And so as soon as you see those spikes, they reset what your base looks like. And that's what we have to be incredibly careful of. Interest rate differentials, I wouldn't be an economist worth my salt if I didn't have some of these charts, so please bear with me. The top line is a policy rate in South Africa. The bottom blue line is a policy rate in the US. And the orange line is a rand. And what you'll see typically, and when we talk about purchasing power parity, and I'll get into it just now, but typically what you'd expect to see and what you've seen is when investors look at South Africa relative to a developed economy like the US, the starting point is to look at interest rate differentials. Because that tells you the risk premium for South Africa. And historically, and you'll see it through sort of the mid-2008 and more recently, that gap was quite significant. And the reason that gap was that significant was because if you are a emerging economy like we are, you'd expect that interest rates are higher there than in the US, because the US is typically seen as being more stable. So you saw the US rates remain flat for a very long time, and ours being exponentially a little bit higher. You can see the gap has closed quite a bit where we are today. Now, again, if you are the Reserve Bank governor, if you look at the historic averages, that gap is a lot tighter than it should be. And with the gap being that tight, the incentive for an international investor to put money in South Africa is a lot lower. Because now the return you're getting for the risk is out of kilter. And so if you're getting less flows from international investors, that puts pressure on the rand. And so you can see where that is. Right? So when you listen to the governor speak often, and he said he thinks the rand will be under pressure for longer still, is because he's talking about this kind of thing. he's saying there's two contexts within which he has to think about the world. The one is the pain that the consumer is taking, because the inflation that we have in South Africa isn't because of reckless consumer spending. A lot of it is actually imported inflation, but it is still inflation, and his mandate is to manage that. At the same time, when you compare us to where the world is, we're a little bit out of kilter. And this is part of why, the market expects that interest rates will continue to rise. Now, if we look at the trajectory for interest rates and where we think interest rates are going to go to over the next while, anyone who's heard an economist speak know that we'll generally have more than one answer for questions around forecasting, so that somehow we'll be right. Like at some point, I'm going to have to be right. If I give you 5 answers, one of them has to be right. But really, what we have is what we call our base case, i.e. the expected case. And that expected case is one where you have, at best, anemic growth around 1.9%. And in that scenario, it's where the global markets find their floor and things don't get significantly worse. The grey listing is an 18 to 24 month period where it's not protracted and very long. And you have, you don't end up in massive coalition politics next year. I think that the difficulty with coalition politics is the ability to get things done. And that's the thing that we don't need. And so that's on our severe down case. Our severe down case talks about protracted war with Ukraine and Russia. It talks about the grey listing being for much longer, massive outcome in coalition politics. That'll put pressure on the country. And the 3 graphs that follow here are basically the different cases. So our best case scenario for us is seeing interest rates remain relatively flat till mid next year, and then starting to taper off. That's sort of our base case. That's what we expect to occur. But to the extent you end up with protracted war in sort of the Ukraine coalition politics post the election next year, the grey listing being for much longer, then we see interest rates increasing by the end of next year by close on 4%. But that'll be sort of determined by where we find ourselves. The last thing, I know lunchtime's coming up, but the Big Mac index is, what this does is it kind of says, it talks about purchasing power parity, and that talks about, given the cost of inputs, where should the rand be trading? And the Big Mac index is used globally. For those who may have heard it, is, what McDonald's has done is, because it's infiltrated the whole world, you can use it as the dollar price index to determine where prices should be. And it sounds ridiculous, it sounds absolutely absurd, until you find yourself in a country that you're not very familiar with and you're not sure what's happening. And when you see those golden arches of McDonald's, for whatever reason, it's like, okay, I think I'm okay here. I don't know what it is about it. They've done incredibly well. And that's actually, just as an aside, that's part of the reason why the US has done very well. The one thing the US has done very well that China hasn't yet is that the US hasn't only dominated with the dollar being the reserve currency, but it's exported its culture. China hasn't done that well. The first time you go to New York and you get there, it feels nostalgic, even when you've never been before, because you've seen it on every sitcom, you've understood it. When you see US brands anywhere in the world, there's something about that that's familiar, right? No one typically sees a Chinese brand and goes there, okay, cool, that resonates. And that's what America's done really, really well. They've tricked us a little bit there. So what this graph really shows us is purely based on purchasing power parity, which is based on cost of inputs and interest rate differentials. Where should the rand be trading? So the South African rand is that blue one over there. So, the dollar is, if you consider the dollar being at fair value, most currencies have been undervalued to the dollar. You can see we're one of the worst performing. At current exchange rates, the rand is probably 60% undervalued. What that says is, to the extent you get a few things right in your own local economy, the space for significant rand strength is there. The space for significant rand strength is there. Interestingly, the only countries, those blue dots up there, that are overvalued relative to the US dollars are the Nordics. So your Denmarks and Norways of this world. The one thing I find interesting about the Nordics is there's a story about Denmark in the mid-90s for a few months having an impasse in their parliament, but nobody knowing about it. Like, nobody knowing about it, right? Because people that hold office, the structures and the systems and the institutions are so in place that if the individual personalities have an impasse, it's largely indifferent. It's not a big story, right? Because the thing that is more important than the individual in the seat is the strength of the institution. And that's the thing that we strive for. That is the thing that is most important. And so when I look at a graph like this, all it shows me, there's two ways to look at it. The one way to look at it is to say, geez, the rand is really undervalued, that's tough. The other way to look at it is say, the amount of potential in this is massive. And I think if, as South Africans, we work better together, these are the types of things that you will see a very quick and accelerated coming out of this. The thing that we also mustn't lose sight of, and many of you who travel around the world will understand this, the rest of the world is really rooting for us. People actually really like this country. And every time you leave, when you come back, there's something here. There's an energy and there's a vibrancy. We have incredible weather, the best bushes and beach. I mean, it's all pretty incredible, and we know that. I'm preaching to the converted. You all run businesses in this country. The truth of it, though, is the level of potential that sits here is huge. And as much as there's so much that we're facing, it's in the working together and the connecting. So for an association like yourselves, things like adopting roads, things like what else can we do, become super important because there isn't another way. We are the ones we've been waiting for. My last slide is really a similar story, which talks about the fair value of the rand. But I will end there because I say I have 5 minutes. To the extent there's any questions, thank you very much. If not, also very happy. Thank you.
We absolutely have some questions for you. And perhaps this is wading a little bit into Ongama's territory, but I'll put it there nonetheless. As I was listening to you, the one thing that struck me was almost nobody has said, oh, you think we've got policy uncertainty now? Wait until we have coalition politics. How would the international markets respond to that scenario come next year?
So there's a few things. I think that coalition politics in the main is a very difficult thing. I mean, it's a difficult thing in a very mature economy, and that's not what we have. So I think the international markets would get very nervous, but the who becomes even more important. So to the extent we end up in coalition politics, where it seems like it's parties that are diametrically opposed in terms of their policies, I think the international market will look at it very negatively, because what all that will mean is there's going to be internal bickering. So if you have, on different sides of the aisle trying to force a marriage, I think that it'll be very negative on rand.
Where does that place the role of the Reserve Bank? You've spoken about the choppy waters we've had to navigate, and from what you're saying, we've done well because of the leadership there. Uncertainty around its mandate, its independence?
That is without a doubt one of the worst case scenarios that can happen for us. I'll use Turkey as an example there. Prime Minister Erdogan in Turkey about 2 years ago kind of said the central bank of Turkey will always be independent. And then what he did was a day before an interest rate announcement, he said, I think they should drop interest rates by 2%. They actually raised rates by 1%. And 2 days later, the governor was fired. The new governor is a very close old friend of his, but he maintains that they're independent ever since they've done generally what he said. And what we've seen is what's happened in Turkey from a currency perspective and the impact. So what we never want to do, one, is tamper with that independence, but B, the issue with the potential. There was a podcast recently around the kingmakers, and they were talking about some of the smaller parties that the belief was the ANC may have to get into bed with in order to. If it's a small thing, if it's a 47% and they need 3.1, that's one thing. If though it's in the low 40s and you need the third or fourth biggest party to be your partner, but they've typically been very, very specific around what they'd require to go into coalition, I think it would spook the market.
Right, on that positive note, what about the role of quantitative easing? Is that something we should consider at all?
I don't think we need to yet in South Africa for a couple of reasons. I think that we don't have the savings, the bank balance for that. So I think that would make things incredibly difficult right now.
Under what circumstance should we think about it?
I think if in South Africa where we were struggling was, because sorry, before I answer that part, if we did QE now, it would cause even more inflation, which would mean rates would go further up. So our issues are a little bit more structural. I think the two things we really need to focus on currently in South Africa, three things. The first one is no new regulations. Minister spoke about, are there any regulations we might get rid of? That's one thing. But we almost have to have an embargo and say no new regs. Because with every new regulations, people have to refigure out how they're going to operate, and that's cost. So that's the first one. The second one is power. We just have to sort out power. So QE is one thing. Let's just do power. I think if we can keep the lights on for much longer and better, South African entrepreneurs and business people will figure out the rest. And the last one is the ease of doing business. If we just move the red tape and get rid of all of those things and allow the economy to function to the extent that it can, I think it sorts out a lot of the problems that you'll have.
I know you didn't want to wade into this, but our perceived, whether we say it is or not, but our perceived support for Russia, what does that do to our perception, and will there be a consequence economically?
I think that what it's done immediately, the immediate reaction is there was a private equity conference in Egypt when the ambassador to South Africa of the US made that statement. Of the 25 private equity funds that were at that conference, 23 immediately said they were going to pull their South Africa mandates. That's just on the day that it was announced. So that perceived support, what you do is you draw a line in the sand and you say, I'm on this side or that side. You know, Ongama and I had a conversation a week or so ago, and what I said was, if we saying we're friendly with Russia through the BRICS and any other reason, I'm reminded of President Nelson Mandela at the time when the US had said, you must turn your back on Fidel Castro, right? What he didn't do is pretend or quietly support. He stood up and said, he is my friend and this is why. Because what the US will understand and Europe will understand is that we're a sovereign state. They don't get to dictate to us, but we must have the backbone and the courage to tell them that. The problem with the perceived issue with Russia is we're almost like keeping quiet about it, and through the back channel, that's how it's being perceived, that through back channels we're supporting. That almost says, you know you're doing something wrong and you're not willing to admit to it. If we stand up and we say, they are our friends for the following reasons. We may condemn the war, but they are our friends for the following reasons. And so we won't condemn them the way you expect us to. The market and the international politicians respect that, because that is a stand you're taking off the back of your sovereignty and showing a level of backbone. It's when it seems like you're too scared to stand up for what you believe that you end up in trouble.
Last question. Is a BRICS currency a reality, and where does that put de-dollarization?
I think that's very far away. I think that, you know, until I can see significant trade happens, I think what people often don't realize when we talk de-dollarization is, for instance, if you have rand and you want to buy euros, as an example, I think what often people don't realize is the only way to do that in markets is to take the rand and buy dollars and take those dollars and buy euros. 90% of currency trades go through the dollar. So it's very, very difficult, actually, to buy a currency pair that doesn't flow through dollar. So I think we're very far from de-dollarization. I think it'll take a step there. I think for a BRICS currency to come in that is significant and that works, even from a policy thinking perspective, if you think Brazil, Russia, India, China, South Africa, we're very far away from one another. So I think it'll be very difficult in the medium term.